Okay, yeah. Thank you for the invitation. This is joint work with Mark Wright, who's here, and Moritz Kuhn. Closer, yeah? Yeah. Okay. So my initial bullet point is actually almost identical to the bullet point, the initial sentence you saw when Mark introduced his paper, and I guess you will see it time and again at this conference. We want to think of human capital as an asset, and if you think about it that way, it's clearly a very important asset for many households. The way we phrased it here, for many households, human capital is clearly the most important part of total wealth. Okay? And in particular, we have in mind the young households. Where I should say immediately, when I say young here, when we go to the data, we mean by a young household, a household with a household head who is young. So age of a household is tracked by the age of the household head. But again, to make it maybe more interesting, and for the theory it doesn't matter, you might also want to think of a young household as a household with young children. Important will be for us, but no, well, let me not jump ahead. Let me first say that we want to think of human capital as an asset with three properties. And we want to emphasize those three properties. And you might want to think there are other properties, but we want to emphasize those properties. And so the first one is that human capital, considered as an asset, is risky. We think of health risk, labor market risk. In addition, and so you want to think probably of this as exposed heterogeneity. But in addition, we want to consider ex ante heterogeneity, meaning at the time of making the investment decision, certain things are already known. And there's heterogeneity within the population in expected returns. And so again, we want to think of young and old households. Young households have higher ex ante human capital return than old households. That's our leading example. Some other people might think of disability differences, but that's not our application. And third, and this is very important for us, and so here the financing side comes in, the financing part, it's non-pledgeable, meaning it's not a good asset. It might have very high returns, but it has risky returns. But if you want to borrow money, it's not a good asset because it cannot be used as collateral. Okay? Absent slavery, you cannot use it as a collateral. And so that will turn out to be actually a problematic property here. So in this paper, we will argue taking these three characteristics of human capital or properties.
Sure, I understand what
we
I would have thought that ex ante heterogeneity refers to kind of protection in investment return or initial value of human capital, not the exposed realization because one person is old and the other person is young.
Point two?
Yes, I don't understand.
But point two, the idea is at the time of decision making. I mean, we think of assets having expected returns and volatility, a riskiness exposed to it. And we think of ex ante returns being higher for young agents than for old agents. Okay, so that's the idea.
No age.
Yes.
Yeah. Well, yeah, exactly. So you're thinking of, at the time of decision making, you know your age, and now you're thinking how much to invest. In the old agent, yeah, exactly. We come back. Well, if you only think of at the time of 23, you make one human capital investment decision. So very important for us, and then we follow also the literature. In our application, for our empirical applications, very important that even at age 25, 26, 27, people still make human capital investment decisions. On the job training, maybe the spouse re-enters secondary, master programs, etc., etc. Yeah. If you don't believe it, if you believe everything, all decisions have been made at age 25, empirically, our empirical application is not very useful. I should say that. But again, there we stand in a long tradition of papers going back to Mincer. So, okay, or maybe it's all in Becker. I don't know. Probably Mincer when it's empirical. Okay, so we argue then, we take these three properties. We take these three properties as our definition of this particular asset, human capital. And we will argue in this paper that an interesting risk insurance relationship emerges in equilibrium. And indeed, what we will find is that those households who are most exposed to human capital risk, and they will choose to be most exposed to human capital risk, and these are the youngs with high expected human capital returns, will also be the ones which are the least insured. They need insurance the most, but the underinsurance is most severely for these young households. Okay? And so let me, before I go through the particular contributions of these papers, maybe it's better to give you the intuition. So we think of households as making a portfolio choice between a risky asset, human capital, and a risk-free asset, which you should think of all alternative financial investments. And other things being equal, and here it's very important to emphasize this, other things being equal, those households with high expected human capital returns, the young, will invest more in human capital. So therefore, they will choose actually to be more exposed to human capital risk. So they will take this risky position. Now, if you now think, and so their demand for insurance will also be very high. Now, if you think of a setting in which we have a complete set of insurance markets, and insurance markets are perfectly competitive, and also credit markets that are perfectly competitive, and we will think of this setting, and if you add that the enforcement of credit contracts is not a problem because we can punish people very harshly, then you would be in what economists like to call an elderberry world, and everybody would be fully insured and buy exactly the right amount of insurance, and so this would not be an issue. However, we will actually think of a setting in which the enforcement of credit contracts, not insurance contracts, the enforcement of credit contracts is limited, so the punishment is limited to a certain extent. And then it can happen that the young households are in equilibrium underinsured because they are borrowing constraints. So there's a link between the credit market and the insurance markets. Young households, think of a young household who is fully invested in human capital, has no financial wealth. This household also wants to buy the insurance contracts. In an elderberry world, he or she could do so just by borrowing enough money. In our world, or more generally speaking, going short, in our world, this household might be endogenously borrowing constrained. It's not only our world. Okay. So the idea is somebody goes to the bank and wants to borrow money without collateral. This is a problem. Now you could say, because the bank would say, I'm not sure whether I will get the money back. Now you could say, well, the bank could garnish labor income. But we have in mind, and so this is a limited contract enforcement part, we have in mind something along the line of Chapter 7 of the US Bankruptcy Code, where you can declare bankruptcy and your future labor income will not be seized. So the only way now to enforce these credit contracts that's still left would be through unsecured borrowing, because if somebody defaults, this person will not have access to financial markets and credit markets for a certain period of time, and that could actually sustain borrowing in equilibrium. And this is a quantitative question. So we will introduce unsecured debt. And we will, of course, have, in a certain abstract way, collateralized lending, but that doesn't work for people who have only human capital. Okay, so here are the particular contributions. So we developed first a general macroeconomic framework with human capital risk and limited contract enforcement, where we modeled the enforcement of credit contracts along the lines of Chapter 7 of the US Bankruptcy Code. We consider first a very particular simple example with young and old, two types of households. So we show then analytically that high return households are most exposed to human capital risk and are the least insured in a very simple two-type example with two types of exposed shocks. We established this risk insurance pattern in life insurance data from the survey, drawn from the Survey of Consumer Finance. So this first part is our, if you wish, theoretical contribution. This part is an empirical contribution. We are not aware of anybody establishing this pattern for life insurance data over the life cycle, and we think it's actually interesting. We show then we move on to a calibrated version of the more fully fledged macroeconomic model, and we show actually that also quantitatively we can account for the life cycle profile of underinsurance that we see in the data drawn from the survey of consumer finance. And then finally, we also argue that the welfare cost associated with this lack of insurance, this welfare cost is substantial, around 4% of lifetime consumption for the young households, not for the olds. By the way, in our quantitative exercise, old households around 50, age of 50, for example, almost fully insured. Only the young households around age 23, 25, 26 are severely underinsured. Okay, so then there's an additional contribution, but I won't have enough time probably to talk too much about this. So there's a methodological contribution. It's about the tractability of the framework we are using, which is very useful for our analysis. Also allows us to prove a certain theory result, which is usually very difficult in these types of heterogeneous ancient macro models. So tractability here means that the endogenous wealth distribution, which is usually a relevant state variable, will not be a relevant state variable in our model. Now, of course, we have to make assumptions. And there will be a certain linearity assumption of the human capital investment technology that will slip in, and I'll mention this. But given that assumption, we get actually a very nice tractability result. Also in these models with limited contract enforcement, where we allow for unsecured borrowing and unsecured debt, there's actually usually always an issue because the value function itself shows up in the constraint set of the individual household decision problem. There's always an issue with the convexity of the constraint set. Also, that issue is resolved in our setting, we can show. The constraint set in our setting is convex, with all the advantages of having convex maximization problems. Okay, so let me go through the model very briefly. This is the production side. The production side is not that interesting and very standard, so it's only on one slide. This is, we have a standard neoclassical production function where we use physical capital and human capital. So that might be the only non-standard part where usually you would expect labor here. This is human capital. Otherwise, this function f has the standard neoclassical properties. In particular, it has constant returns to scale, which means in the end we have endogenous growth, which is not too important for my talk now. So from now on, I will not mention it, but it's in the end an endogenous growth model. We assume on the production side, competitive markets, producing firms will hire physical capital and human capital or labor in the capital market and the labor market. Competitive pricing gives us a relationship between the rental rates and the capital to labor ratio, which in our case is the physical capital to human capital ratio. From now on, I don't have to mention this part anymore. Okay, so the interesting part is the household decision problem. We emphasize idiosyncratic risk in this paper, so no aggregate risk, just because we have to start somewhere. So you should always, when I speak of risk and shocks, you should always think of idiosyncratic shocks. And we imagine a large number, indeed a continuum of households, and now consider the preferences of a particular household. This is one particular household, which I don't index by an I here. So then one particular household has standard time additive expected utility preferences with a simple log utility, one-period utility function, log utility. This can be, in terms of the tractability result, to be generalized, of course, to constant relative risk inversion. Indeed, we could introduce Epstein's in, but for the quantitative analysis, we use log utility, and sort of our approach is, if it works with log utility, good. Of course, if you need something more complicated, and we don't have to, you would have to introduce it. So that means also we use moderate degree of risk aversion, I would say. Here's the idiosyncratic shocks and also ex-ante heterogeneity, I'll explain this on the next slide, will all be introduced through this exogenous individual state, through the state ST. Standard notation here, superscripts, is always the history of states. Very important, this state can have several components. The state can have several components, and it's a Markov process. So here are two examples. The simple example for which we prove the theoretical result is an example in which the state, the exogenous state, has two components. The first component is a very persistent shock, if you wish. Indeed, we have full persistency, which is a type at that stage, and the type is young and old. high expected return or a low expected return. And the other component will be an IRD human capital shock, meaning a shock to the stock of the human capital of the household. And will be IRD and will also only take on two realizations, good and bad. In our quantitative analysis, we have a life cycle model. Okay, so the first part type refers here to 23 ... until age of 60. Then we have a stochastic transition period, and then a stochastic retirement. And coming back to your comment, at each point in time, the household can still make a human capital investment decision, but at each point, meaning at age 23, 24, 25, 26, but your age is known at that time, therefore the expected return is known, and that changes deterministically over the life cycle. So that's the interpretation here. However, at the time of decision making, I still don't know which labor market shock or which mortality shock. We will introduce mortality shocks because when we go to the data, we will have data on life insurance. And so at the time of decision making, meaning when I make the human capital choice, I still don't know next year whether there might be the event of the death of a household member. And I will not know exactly the labor market conditions, my idiosyncratic labor market conditions. And so that's where the risk comes in. But it's all in the state ST. Okay, so here's the budget constraint. The budget constraint tells you basically what type of decisions the household can make. And so what we imagine is that the household can either consume, invest in human capital, invest in a risk-free asset, buy insurance contracts, and also can go short, meaning borrow in a risk-free asset, go short in a risk-free asset, borrow money. Okay? So the borrowing and the buying of insurance will all be put in error securities. So for each state, we introduce one possible contract that can be purchased. And we assume, by the way, therefore, complete markets. So there's a complete market structure. And on the next slide, I will also, in 2 slides, I will make the assumption that these markets are perfectly competitive. There's an equivalent formulation where I multiply the investment by some productivity parameter. So if you don't like, for example, later my interpretation that old households have a higher depreciation rate than younger households, because you say there's just no depreciation of human capital, then you might want to just translate everything I will say into the statement that old households have a smaller productivity of human capital investment than younger households. And then there are some people who argue even with this, I know. And then, of course, meaning that young and old households always have exactly the same expected return in human capital investment. And then in terms of our empirical application, we would have some problem. As CEO remarks, thinks I shouldn't have made that comment. Because but anyway, so that's the idea. I should also say that we assume, and this is for the tractability reason, therefore here, we assume the linearity. We assume that at the micro level, at the household level, we assume that the marginal product to human capital investment is constant. Last comment, and then I move on. You might want to say, well, here in this formulation, we only allow for the cost of human capital investment to be a direct cost, monetary cost. What about the time spent, the opportunity cost formulation, which is much more common, Ben Porat, etc. You can introduce this. This is not the big issue for us. You could introduce it. We discussed it in the paper. It wouldn't change anything for our analysis. It can change other things when you discussed optimal tax policy. I understand the difference. Okay? But for other analysis, it wouldn't change much, except that you would still have to use a formulation where you have a time cost of human capital investment, and where in this equation, you can introduce this time cost of human capital investment, and you can assume a quite general function here, but this always has to be linear in H and I. But you can multiply these functions by some productivity that depends on the time spent in investing in human capital. So that you could do. And for our analysis, it will be observationally equivalent, because I should say immediately, we do not think that we have direct evidence on delta H. We just take this as a parameter we have to estimate indirectly from the data. Okay, good.
Can I ask, when you take this, so right now you have the ST effective depreciation rate rather than the rental rate. Is that going to be true when you take the data, or is that just
we have the delta H instead of
say letting ST influence the rental rate?
The rent, no, exactly. It's another point I haven't made. Also observationally equivalent.
When you get the data, it seems like a lot of risk is somebody losing their
yes,
job,
yeah, sure.
not working and having zero earnings.
Exactly.
But in your model, you can interpret that as your human capital depreciates to zero.
Okay, 2 or 3 comments to this. This is a very good point. I mean, the first point is the risk we have in mind is a risk that the human capital stock, or the important risk in the application we have in mind, is that the family, total human capital stock of the family or household decreases, if you think of downside risk, permanently. That is actually an IID shock in human capital, which translates later, and we show this in our framework, into a labor income process that is a log random walk. So you see already. Now there might be another, if you think of an unemployment spell. So an unemployment spell or the job displacement has 2 components. This permanent component and the temporary component. For the general framework, we can introduce it. And it might be interesting to do this on top of what we do. We don't do it in this paper. And so therefore, all our quantitative results are results that only focus on the one type of risk, or the one part of this type of labor market risk, and actually neglect completely the other part. You might want to think of this as full insurance for transitory shocks, for the transitory component of the income shock. Okay. Now, of course, if you introduce what you wanted, that would only strengthen our point. Because then there would be even more risk and even more underinsurance, and would just strengthen our point. But then we would have to take seriously also that, of course, there are self-insurance. Well, we take it seriously. There is some self-insurance also in our model. Okay. So my conjecture would be that the quantitative effects will not be much stronger than once I introduce also these transitory components of the income shocks. Okay, but that's a good point. And then on a formal level, it doesn't matter at all for us whether we make the RH S dependent or the delta H. But there I would argue, again, that's observationally equivalent, because what we see is RH times H. So RH is the wage per unit of, okay, so that's a very important point. RH, the rental rate, is the rental rate for 1 unit of human capital. As long as I don't have direct data on human capital itself, and that's how we approach the data, we only see RH times H. And then it's observationally equivalent in many examples, whether I put the shocks into the RH or the H. Yeah, okay, so there were 2 points to your question. The first about the RH, the second, the permanent. We focus on the permanent shocks because that will be important. If we add transitory shocks, well, that will just strengthen the main points we want to make, because it will actually add something to the underinsurance problem, which is the main point of the paper. Oops. Okay, so good. So, but if I stopped here and just said, well, and then I add to this, I have to add something to this budget constraint. If I add to this budget constraint a no Ponzi scheme condition, just to make it a well-defined utility maximization problem, then the outcome in equilibrium would be, assuming that these assets, these financial assets, are correctly priced, the outcome would be that all households would be fully insured against all types of risk. What we, however, introduce is, instead of a no Ponzi scheme condition, which is very weak, we introduce a condition that households can only go short in assets or borrow up to the point in which they have an incentive to default. And once there is an incentive to default, and they would default, we assume that financial intermediaries here would not lend to them anymore. Okay, so the possibility of default, although even though in equilibrium there will be no default, the possibility of default, the possibility that households can walk away from their promises, a credit contract is a promise, will actually constrain how much they can borrow. Because everybody knows in a certain sense everything, well, not everything, but the structure of the market is known. And so it would not be in the interest of profit maximizing banks to borrow, to lend money to those households who would just walk away. Okay, so the participation constraint then formally will be defined as this inequality constraint, which says that the household can only choose consumption plans, and the consumption plan here, which shows up on the left-hand side, is financed by a particular asset holding plan. Okay, so these A's are implicitly there in the participation constraint. They just don't show up directly. And so it says that the continuation utility from choosing the consumption and asset holding plan must be greater or equal to the value of defaulting, of walking away. And so now you see, of course, this constraint and our quantitative results will depend very much on what we assume what should show up on the right-hand side. And the value function that shows up on the right-hand side depends very much on what we think are the consequences of default, or what we assume. And so what we assume is what we think is along the lines, along the lines of the chapter 7 of the Consumer Bankruptcy Code. We say all debt is canceled. By the way, in our model, it also means, because we treat all assets, financial assets, equally, it also means any type of asset the person holds will be seized. Okay, so they start with a total asset holding of 0. Now, you might want to introduce more complicated models where you distinguish between different financial assets. Indeed, our first version had it, where we were thinking of housing and non-housing. It was very interesting, but was leading us away from the main point we wanted to make. Okay, and for that reason, we are using the simple version.
I don't want to get caught up in policy details at this juncture. But student loans are unique in the sense that they're non-dischargeable in bankruptcy.
Yes. My last slide. Can I come back to that?
Yes, you can.
That's our, I probably forgot to mention it on my first slide. We have one policy application. Actually, that's sort of, which this is a very, still a very general model, where lots of details are missing, but that would be our interpretation. What would happen if we treated all consumer loans as student loans are treated? In our model, it's a good thing. There might be negative incentive effects, because when you seize the labor income of a person, that person might not have such a strong incentive to work. That's not here and in the model, but that might be. But besides that effect, in terms of contract enforcement, and in terms of solving our issue of insurance, of lack of insurance, that's a good thing. Making consumer bankruptcy similar to defaulting on student loans, which is obviously a much harsher punishment. It is. Yeah, so I come back to this. That would be one way of solving within the context of this framework, solving the issue. And indeed, we conduct this computation. It would have a very strong effect according to our quantitative analysis. Okay, so very good. That's the last slide. That's our policy application. And so consequences of default, so all debts, it's canceled. We assume then that after default, the household will be excluded from financial markets, in particular credit markets. But going with the theoretical literature, we assume complete exclusion from all financial markets. It's, in a sense, a little bit of a harsher punishment than maybe in reality. So our exclusion from financial markets for a certain period of time, which is determined stochastically. And in the quantitative exercise, we choose that period of time on average 7 years or 10 years. Now I forgot which one is our baseline calibration. We switched always because in the literature there's always this 7 years and sometimes there's a 10 years. I think we have 10 years now. And so, and very important, no garnishment of labor income in the baseline model. And then in the policy exercise, we will ask exactly the question. We will ask the question, what if we had a policy code, a bankruptcy code, which dictates that also labor income can be garnished? Not the human capital itself, but the future labor income. And that would change things and would actually allow households then to borrow more because banks would be more willing to lend to them. It would be rational for banks to lend more. Okay, so here financial intermediation, as I already said, in equilibrium there will be no default. There's perfect competition also in the insurance market and in the credit market, so insurance companies and credit companies or banks price these assets competitively, and there's risk-neutral pricing therefore here. I should say, therefore, well, I shouldn't say it, I have already said it twice. Therefore, in this model, the issue, again, coming a little bit back to the policy implication, is not the non-competitiveness of the insurance markets, which is not to say that I don't think that the US health insurance market might have some non-competitive features and some other problems, but it's not, that's, the point of our paper would be maybe even if you could resolve these obvious inefficiencies, well, I should be careful, but to me some obvious inefficiencies, there could still be an issue, meaning in insurance contracts, health insurance contracts or life insurance contracts. That's the reason, by the way, why I think the life insurance exam is a little bit better, because I have an easier time to believe that the US life insurance market is quite competitive and the private market, but maybe not. But for the either way, we would say, well, even if everything is priced competitively, there's still an issue. There's still an issue because people would, in general, young people would have to borrow in general to buy the insurance and invest in human capital and consume. All these things are competing. Yeah, all these are competing, and there's a constraint, a budget constraint for the household. Okay, and so then this issue is still there. Okay. So standard definition of a recursive equilibrium, stationary recursive equilibrium. I will not go through this. Here's just the key insight that tells you why the model is tractable, and that also shows you that the formal analysis conducted within the model is very similar to the intuition that I have proposed when you think of the household decision problem. So you can rewrite the sequential budget constraint of the household by defining a variable called total wealth, which is human wealth plus the value of all financial assets. So that's just in line with the idea that human capital is just another asset, and there are all the other assets, and let's just take all these assets and calculate the total value. Then you can also introduce a portfolio choice variable. The theta h is simply the fraction of total wealth invested in human capital, and you can do this for all financial assets, et cetera, et cetera. These are just definitions, but what you can then show is that given the structure of the model, there's a Bellman equation, the recursive formulation. There's a principle of optimality which still holds. Qualifier here, because of the participation constraint, the Bellman equation, the operator associated with the Bellman equation is actually not a contraction mapping that is known in the literature. It's a general, just a monotone operator. But you can still prove the things you need to prove. And you can show for our particular example then, using the Bellman equation approach, that the optimal policy of the individual household, the optimal choice of the individual household is very simple. It's a consumption choice that is linear in total wealth, and it's a portfolio choice that is independent of total wealth. And so these are the features that are important. You would say, well, that's standard finance, the Mertens problem. Yes, it is standard finance, however, with a twist that there is a participation constraint. And the standard finance problem of a consumption saving problem and a combined portfolio choice problem does not have a participation constraint. Now, just one more minute to comment. The participation constraint mathematically is an ugly object because it introduces the value function into the constraint set. So you're beyond Stokey-Lucas, obviously. Right? But again, this is not completely new. What is maybe sort of our contribution is that in our particular framework, but once you understand the framework, it's probably clear, that in our particular framework, these simple policy, optimal policies are still, the optimal policies are still simple. Okay, proof, yes. And here's a general tractability result. The first tractability result is for the individual household decision problem. It's very simple, and also, by the way, the constraint set is convex. I forgot to mention this. The second and more interesting tractability result, or also equally interesting tractability result, is that now in general equilibrium analysis, when we conduct general equilibrium analysis, we do not have to keep track of the wealth distribution. It is not a relevant state variable for general equilibrium analysis. That follows, of course, from the linearity, a certain linearity of the individual policy functions. And so there you have already an idea, maybe, where this tractability result comes from. Okay. So this is as much as I wanted to say about this. And now here's our theoretical result for the simple economy with two states and two types. The theoretical result says that, think of an economy with young and old households, high expected human capital return, low expected human capital returns. Then young households will invest more in human capital in terms of their portfolio choice, by the way. Not necessarily in absolute terms, but a larger fraction of their total wealth will be invested in human capital. So theta H is really the relevant variable. And insurance, there will be less insured. Well, what does it mean to be less insured? So here we have to be very careful, and here we are guided by the theory to a certain extent. Here we define measures of insurance using our theoretical approach. So the first measure of insurance we use has something to do with consumption volatility. That seems to be very natural for many maybe empirical economists. So here we say we introduce a ratio of volatilities where the numerator here is the volatility of consumption if the household has access to financial markets. And this other standard deviation is the denominator is the standard deviation of consumption, or consumption growth, I should say, if the household has no access to financial markets. So this ratio basically tells you to what extent access to financial markets reduces the volatility of consumption, Then we have, and that's our first, and then we have to take 1 minus, because this would be a measure of underinsurance, and if you take 1 minus, you have a measure of insurance. Then we take a second measure of insurance, and this measure of insurance is important for our empirical analysis, because in our empirical analysis, we indeed have a situation in mind in which there can be a good shock or a bad shock. Only 2 states are possible. Either in the next period, in the next year, an adult member, I should say, of the household passes away, or the event does not happen. And then we want to say, if the bad shock, the bad event happens, what is the insurance payout, and what is the human capital loss? And what is the insurance payout relative to the human capital loss? And if the insurance payout, the payout to the insurance contract that was purchased previously, if the insurance payout is exactly equal to the human capital loss, then we would say there's full insurance. If the person has not purchased any life insurance, then we would say there's no insurance. So we want an insurance measure also that varies between 0 and 1. And that's how we define it here. Here you see insurance payout, and here you see human capital loss, where human capital loss is the fraction of total human capital times the human capital portfolio choice. Both numerator and denominator, by the way, are multiplied by total wealth, and total wealth drops out. And that's actually very important when we go to the data. Okay, so this is our insurance measure, and then given these 2 insurance measures, in the theoretical example, we can prove that for both insurance measures, our general relationship holds. When we go to the quantitative analysis, I've already mentioned this, we have the life cycle model. We have 2 types of human capital risk. The one is the death of a adult household member, I should say, widowhood. And the other type of human capital risk is everything else. Labor market risk, disability risk, etc. We put everything else into the third component. Here's how we calibrate the model. We choose age-dependent depreciation rates, again, depreciation rates in quotation marks. So in order to match the life cycle of median earnings, which we take from the data. So indirectly, we extract from the data the heterogeneity and expected human capital returns by looking at the life cycle profile of median earnings. We choose human capital risk, the mortality risk here, to be consistent with the empirical evidence of mortality probabilities, and also in the case of the bad shock, we choose the human capital loss to be consistent with some of the empirical papers that have investigated what's the median labor income loss to a household when 1 adult member passes away. Okay, so we try to find a number here. And we choose all the other risks to be consistent with the large number of empirical papers on labor market risk, where usually, of course, everything is decomposed into a transitory component, a permanent component, or maybe even 3 components. And when we calibrate our model, we are careful in order to avoid putting too much risk into the model. We are only looking at the standard deviation of the permanent component, and that's how we calibrate our model. So we throw out basically all the transitory shocks and the shocks with medium persistent. So we are not putting too much risk into the model, I'm quite sure. Actually, we're putting rather a little bit too little risk into the model, which is good given that our point is there's a lot of underinsurance anyway. Okay, so our own data analysis, which refers to mainly the life insurance data, but we also look at the wealth data, and the labor income data uses a survey of consumer finance. Most of you know probably these things. We use actually several surveys between 92 and 2007, and we always compute median values. I should always mention this. So this is our life cycle profile, which is very similar to other life cycle profiles. This you can translate into earnings growth rates, of course, over the life cycle, between 1 year. Between 23 and 24, there's an earnings growth rate, and we match this earnings growth rate profile. But then, of course, we also match this profile up to a constant. So this is what we put in. And so there indirectly we put in a particular heterogeneity in expected human capital returns, namely that one which is given by these, by this life cycle profile of labor income growth. So here's our first result. So our first point is about portfolio choice. And the portfolio choice implication of the model are interesting. Now, we don't observe the portfolio choice directly. But what we observe is net financial wealth, which is in the data called net worth. That's the value of all assets you have except human capital, of course, minus the value of all debt. And we observe labor income. So instead of our theta H, the portfolio choice itself, we don't observe. And the problem is that we don't observe, we take the point of view, we don't know exactly what the human capital level of the family is. But we know the labor income, and in this theory, labor income is generated through human capital. So once you know labor income, you know indirectly human capital. So we calculate this ratio in the data and also in the model of net worth to labor income. And that's our measure of portfolio choice. When this ratio is very large, people are heavily invested in financial wealth. If this ratio is very low, people are heavily invested in human capital. If this ratio is 0, people only hold human capital. That's our idea of portfolio choice. And so the red points here are the data. And this is not, our model is not calibrated to match this target. It's almost too good to be true, I know. And this is the model prediction. That means the model is quite consistent with the portfolio choice over the life cycle we observe in the data if we construct such our measure of portfolio choice. And this is very important for us as well, because our problem is for people who hold a lot of human capital and little financial capital. And therefore, it's very important that we match this dimension of the data. If we didn't match this dimension of the data, you could question our quantitative results. Because then, obviously, I have to say, however, we match median values. And at this stage, we don't have heterogeneity within age groups. So the median in the model is equal to the mean, but not in the data, not at all, I understand this. And so we have to make a choice, and the choice is that we match the median. Okay, so now we come to our main result about insurance. So now I already told you what the insurance measures are we have. And so let me first come maybe to the model implications. The quantitative, the calibrated model implies a significant increase in insurance according to measure 1 and 2. So let's look at the model implication first. So this is the volatility measure, the insurance measure that uses consumption volatilities. Initially, less than 30% insurance for young households, and that goes up to a little bit above 80%. In terms of life insurance, so this event, bad shock, good shock, in the calibrated model, you also see the positive relationship. However, this is a very small probability event. In the model, people are better insured against this particular risk than they are insured against everything. And so we start at around 2/3, and it goes up all the way to 1 in the model. This is the model. Okay. So what about the data? Well, we have to think a little bit how to construct the data. This is our problem, so let me go back. So if I want to construct the insurance measure for life insurance, what we see in the data is definitely the insurance payout. We know what contracts people hold and how much they would get in the case of the death of a household member. What about the loss of human capital? Well, we don't know. Again, our position is directly we never observe human capital. However, we know what the labor income would be, and we know on average, we assumed already in the model, what fraction of labor income or human capital will be lost. So we used a eta bad, this is a fraction of human capital being lost, when we go to the data, that is equal to what we feed into the model. Just for at least we have to be consistent. And then we, instead of taking human capital, we take the present value of future labor income. Yeah, so we say human capital equals present value of future labor income, which is equal to current earnings, current labor income, times the present value factor. So that's how we proxy it. Human capital is replaced by the present value of earnings, and we take how much human capital is lost in the case of the bad shock. We say we have to assume what we assumed in the model when we go to the data. So then when we go to the data, from the data we have this, this we have already specified, and a present value factor we calculate taking the earnings profile we have fed into the model and we observe in the data. And so that we can construct also empirically this ratio. Okay. So when you look at this ratio, what you see here, the points are the empirical results for the life insurance data. Now there are 2 data points for each year. The red points, or stars, these are supposed to be stars, the red points, they depict the insurance measure for all households that have purchased some insurance. So conditional on being in the insurance market, this is what we see in the data, and this is our theory prediction. That means the theory does very well also quantitatively, qualitatively anyway. I mean, qualitatively, there's almost no way, well, there's some way of transforming the data maybe, but I think we are very safe that qualitatively there is this relation, something is going on here. But even quantitatively, the model does very well explaining the intensive margin, meaning conditional on purchasing some life insurance, we explain very well how much life insurance people purchase. However, when you look at the entire sample of all households, many households do not purchase life insurance, then you would see in the data, again, a relationship, a positive relationship between risk and underinsurance. Yeah? But you would see that young agents, young households, are much more underinsured than what we would predict. Okay, so then we, therefore, in order to also match the second dimension of the data, this extensive dimension, we go to an extended model in which we introduce additional heterogeneity in family structure. That's our interpretation. Think, for example, number of kids. So at this stage, we have written down a model where every family is the same, basically. Of course, maybe you're not surprised that we can quantitatively account then for the extensive and intensive margin. That's a little bit too much to ask for. And so we introduce family structure. By the way, family structure and heterogeneity in family structure itself wouldn't change our analysis. What's important is that this heterogeneity changes with age. Yeah, so the age depends. Otherwise, it wouldn't matter that much for an analysis. But anything that varies systematically with age then could change our analysis. And therefore, in terms of our analysis, it would change the size of human capital, the fraction of human capital that is lost in case that the bad shock is received, or 0, okay. Yeah, so the simple idea is, if you're a single person household and you pass away, then, or if, well, actually I have 0 minutes, so let me not go there. So some families have no need for life insurance. They have 0, and then some families need life insurance. And so we introduce this additional heterogeneity. And so with this additional heterogeneity, we have now also in the model some people who are out of the market, out of the life insurance market, and some who are in the market. And we can actually match both the intensive margin and the extensive margin. So calibrated model is also consistent with consumption inequality over the life cycle. Just very briefly, just some people say if you write down a model of this type, you always have to match this dimension. It's not the focus of our analysis, but you could say, what about the consumption inequality and how it varies over the life cycle? But that you can also explain with other types of models. It's very clear. It's not a distinguishing characteristic of our model. And finally, the calibrated model implies, I've already mentioned this, substantial, significant welfare cost of underinsurance for young households. So here's a picture. Initially, underinsurance and the welfare cost due to underinsurance is very large. This is almost 4% of lifetime consumption. And it falls very quickly. Okay? And finally, coming back to the comment, also policy implications, but we conduct, you could ask now what type of policy reform could lead to a welfare improving increase in insurance and human capital investment. And the one type of policy experiment we consider in the paper is simply introducing a more stringent bankruptcy code, so the possibility of garnishing also labor income, which is what is being done in the case of default on student loans. Another type of policy analysis would be to subsidize credit. -1, exactly. So then I stop here. Oh, sorry. Okay.
All right, thanks for the organizers for inviting me here. It's a very nice paper. You didn't see a slide on how it relates to the topic of the conference because it couldn't be any closer to the conference. It's exactly about financing human capital investment. We have these people in the model. They have to invest in 2 different assets, one of which is human capital. And the question is, how do they do that in the face of very high risk? I think we also can disagree with the basic facts. Human capital is indeed the majority of capital in the economy. We know labor income is more than twice as large as capital income, which means that human capital is really the dominant form of capital in the economy, which is something people seem to be somewhat unaware of. In my undergrad classes, I always ask my students what they think their total lifetime income is going to be, and they're always shocked if it turns out to be in the millions. Somehow it hasn't really crossed their mind yet, but it's something, I guess, obvious to people in this field. So this is a very nice paper for a couple of different reasons. It addresses big issues, and it's also very successful in terms of getting analytical results. So it's a very elegant model. It makes kind of the right assumptions and can get surprisingly far with just using theory. Of course, they have to make some assumptions to get that, and you mentioned the linearity in returns is kind of crucial, which does mean that the model has somewhat extreme features. So if you think of the first best in this model, it does have the feature that only one type of agent should be investing in human capital. If you think of the simple example, there's going to be one type that has a higher return, so they should be holding all the human capital in the economy. Everybody else should only be holding physical capital, which is something to keep in mind when you then think about the policy implications, because this is something that's probably going to be different in a richer model with decreasing returns at the idiosyncratic level. But nevertheless, I think it's quite impressive what they've achieved just in terms of theory, how far they could get with this kind of analysis. What's even more impressive, I think, is that they also went beyond that to a quantitative analysis. Usually, once you have propositions in your paper and you prove them, you're no longer required to match the data. But they nevertheless try to get a bunch of data, and you saw some of the pictures, if only briefly, and it's really quite remarkable how well this model does, both at matching life cycle profiles in consumption and human capital investment, but also in particular on that life insurance dimension. So that's something that hasn't been done before, trying to capture the life cycle profile of life insurance with a model of this kind. It does really very well. So kind of this combination of a very tractable model that will be useful for other researchers also, and very convincing quantitative results, that I think is quite a remarkable paper. Of course, having relied on certain assumptions to make the model tractable makes it easy for me to criticize those assumptions. Maybe just do a couple of those criticisms to get the discussion started, and I will hand things over to other people. So the first remark I have about these assumptions is on the nature of human capital risk. The model relies on the assumption that returns are essentially linear in human capital, which means that risk is also linear in human capital. If you invest twice as much in human capital, that will just scale up your total risk by the same amount. I think it's an important question whether the nature of human capital risk in the real world really is like that. And one issue to consider there is the question if there's not some other factors that make actually human capital more risky for those people who have less of it. There was an earlier question about unemployment. We know that unemployment risk is much more pronounced for people with less education, for example. We also know that in the United States, at least health insurance is tied to employment. So if you're less likely to be employed or more likely to be unemployed with less education, that also means you're going to be more likely to be uninsured for health, which means you're going to have more exposure to health shocks. So there's a number of factors that would actually suggest that those people who have less human capital may be more exposed to at least certain forms of risk, downside risk in particular, that something might really go wrong in your life. Now, the upside risk is going to be higher, but that's maybe something that we worry about a little less. So you have, in particular, talked about life insurance. Here, this might seem a bit more natural to assume the linearity because it's really about replacing your income. But even with the life insurance, I think you can make some arguments that there's some factors going the other way. So the one very obvious thing is that with less education, less health insurance, you're going to be more likely to be dying. So there's a kind of a direct effect on the probability of death. But there's also that you should really think about this a bit more generally. This is really the risk of a family losing one income. It could happen through death, which is a drastic thing, but it could also happen through family dissolution. You could have divorce, you could have some spouse leaving, or you may not even succeed in getting married and be ending up raising your children yourself. And we know in the data that those things are risks that are, again, more pronounced for those with less education. So I think if we allow kind of for a richer relationship of human capital and risk, there might be some other factors that might drive things in a different direction. In fact, just yesterday I was reading in The Economist about Korea, and they were talking about that in Korea now, more than 70% of high school graduates go on to college. And they're kind of raising the question whether this is not really too much relative to what's really efficient in terms of production. And the argument they're making is exactly what's kind of in this paper, but in reverse, that people go to college because that's the entry ticket for a job in the government or at Samsung, where you have kind of guaranteed lifetime employment. You're no longer subject to that much risk, whereas if you don't go to college, it might be the right thing in terms of the efficiency of your human capital, but it exposes you to a lot more risk over your entire life. So I think one challenge for the more empirical literature will be to really characterize what's kind of the important components of risk and how does it relate to investment. I think it's going to be possible that we're going to conclude that at least in some countries, in some cases, we actually have overinvestment from this perspective as opposed to underinvestment. A second dimension, which I think is important to explore, is the nature of market failures here. So the reasons that markets aren't perfect in this model is limited commitment. People can walk away from their obligations. But another very natural possibility is moral hazard limiting the amount of risk sharing in the economy. So if I again think of my own life cycle, back in second year of graduate school, I would have been very happy to write a contract that shares risk among all the students back then in the class at the University of Chicago, because that would mean that right now I would be getting a huge income stream from all my colleagues who are now at Goldman Sachs making enormous amounts of money. And many of you here would be in the same situation. But we didn't really write this contract, and the question is, why didn't we write this contract? I would think that the bigger reason, other than limited participation, was a moral hazard. Namely, the fact if we had written that contract that those guys no longer would have found optimal to apply to Goldman Sachs and make all this money just to give it to the others of us. Career choice is endogenous, whether you choose a job that's more compensated in terms of money or other goods. So once you think of those factors, you will also get a big limitation on risk sharing. And this kind of matters for policy, because this moral hazard reason of market incompleteness might be a lot harder to address with a policy. Now, if you have limited participation like in this model, you can do something, as you point out in the paper. You can make bankruptcy much more severe, and you will accomplish more risk sharing. But if moral hazard is the main problem, that might be somewhat more difficult to achieve. So just a couple of thoughts about how going to richer model might change some of the conclusions. But again, I think overall it's a fantastic paper and really quite an accomplishment. So that's my introduction. Maybe if you guys want to respond to that or other questions. Mm-hmm. Yes. Mm-hmm.
Except if there are related questions.
Should I give you? Yes. Mm-hmm.
Okay, so the questions are obviously excellent, and they're important. That's the reason why I want to immediately, especially the first one. If we were completely right, we would be in big trouble, I think. But the empirical data do not completely support what you said for all types of risk, and so that. But the two comments. So the idea here is saying that when we invest in human capital, and this is really not in the model, we not only have higher returns, but we reduce automatically the risk itself, whereas we have assumed that the percentage shock, and this is very important, that the percentage shock to human capital is constant, independent of the level of human capital. And so you could say, well, let's see, if you think of labor, and now it depends a little bit what risk we are looking at. If you think, first of all, of human capital investment as different education groups, meaning college versus non-college versus non-high school, then the first comment I should say, given in our quantitative application, you should rather think of this as an initial value of human capital. So it's, that's the first point. And so we should actually rather investigate it, and we have done that actually a little bit, not in the paper, as having 3 different types. Yeah, and so that, but that's still an important issue because they would make different choices also. They have different expected human capital return. But secondly, besides this qualification that in the model we should, because in the quantitative model we start at age 25, right? So it's already done, that type of investment. What would the empirical literature say if you think of these 3 different education classes? If you think of the literature on labor market risk, how about the standard deviation of the permanent component of labor market risk? Is that monotone in education? The way I stare at a paper like Pistaferi-Meguiar and Pistaferi or a couple of others, and I've done this myself once for Germany, it seems to be a non-monotone relationship. Because again, it's percentage. I agree that the probability of becoming unemployed is much higher when you are a high school dropout. But the loss relative to your labor, the percentage loss of your labor income is also much lower when you become unemployed. There's just not that much variation. It's all between $0 and $5 per hour, right? So versus, so you see, given the way we measure things, and when you try to match it to the data, it is not true that the variance of the percentage change in labor income is decreasing with education. At least that's my reading of the empirical literature. But it's also somewhat non-monotonic, so it would be still interesting to put it into the model, right? So that's my comment. If you think now of mortality risk, you are again right, the probability probably of becoming ill and passing away is probably higher for low-educated people. But again, the size of the income loss could be, again, there you have to think a little bit about relative to it. So it's all about probability and how much you lose. And if you put those 2 things together, empirically it's not clear anymore, actually, whether there is such a simple monotonic relationship between risk and education. And so we might not be missing something that important, but for many types of risk, we might be missing it, and we cannot incorporate it this way. And the second comment is the way we would, if it's about education, we would have to incorporate it as initial condition in the quantitative part. But on the second one, moral hazard, yes. So our paper is probably, I don't know whether Mark wants to answer to this. We are just silent about whether other market frictions or other problems, moral hazard and adverse selection, could be the reason for some incomplete risk sharing. Of course, we believe. So our point is maybe that this still could be quantitatively important for some insurance markets, and we show it. And so far, this type of quantitative analysis has not been successful in the literature, and we've done that first, and we argue it could be really a potential problem that is big. There might be other problems, and there might be also be big.
Maybe take one question. Yes, yes, we have one right here.
Yeah, this is to put the paper in a longer-term policy context. I was very interested in your comment about moral hazard if a group of your colleagues had entered into a Miguel Palacios kind of contract in which you all benefited from each other's well-being, and you understand that they didn't do that for a set of reasons. We have a circumstance at the end of World War II where we had high taxes and a very, very substantial education grant to a large number of people. In essence, this addressed the inability of young people to acquire human capital because they didn't have the access to credit. The society at large provided that human capital grant. We had high taxes, a large human capital grant, and economic growth and development proceeded fairly satisfactorily. We have a circumstance now in which we don't provide those kinds of societal grants of human capital acquisition through instead we do it through a private sector in which students become extremely indebted. And what I'm wondering about is, what does this model tell us, or this approach tell us about the degree to which a society should provide a young family the resources it needs, or should we continue to do as we're now doing, it seems, or to weigh more towards the end of the spectrum in which we're requiring the young family to become itself personally indebted and unable to discharge that debt.
Who's answering? Mark or? Not me. Mark hasn't said anything yet. I'll give the microphone.
Thank you so much. Thank you to all of you for all the comments. Some big questions there. I don't have answers to all of them. Let me just point out a couple of things. I mean, one of the problems with studying labour market risk is that there are many, many different forms of insurance against it. Not just the market kind of insurance contracts, such as the life insurance contracts that we study, but there's insurance within the firm, there's insurance across broader household groups within the family, there's insurance from government provision of unemployment insurance and so on. One of the reasons we focus on life insurance is precisely because it's a market one that we have good data on. It's something that, although moral hazard concerns are arguably important, we'd argue are maybe somewhat less important than in other kind of things where it may be about working effort or the choice of a job. So that's the reason for our study. I think we're kind of forced to do it a little bit for the data. It's a little bit cleaner, and also because I think it cuts through some of these measurement and other theoretical issues that people are concerned about. On the issue of kind of broader societal methods for enforcing loan contracts and encouraging investment, we see around the world a lot of countries are moving to systems in which you have an explicit government-provided educational grant that is then enforced, or your repayment of which is enforced through the tax system. And that's something that maybe the US needs to explore as well. It's something that's at present in my home country of Australia, and I know other countries have looked at it too, and I think that there's a good case for maybe looking at it a bit more.
Yeah, I would just, just for a minute say the same thing. I mean, given our approach, there's nothing wrong with having the government do it. Or you can do it more complicated by subsidizing credit or punishing people more when they default. But obviously there's certain elements missing in this model why you might not want to punish them too harshly. And so for that reason, in the model would also say if the government just took care of this and gave the grants, fine, great. Which I tend to believe anyway, but.